Yo, my name is Sebastian Zavela. So let's say you heard about a particular stock and wanted to do some research on it. So where do you start? Or have you ever went on Google and searched a stock and wonder what all this means? Well, this is called a stock table and it gives you some basic information about a company's stock or a fund. It gives you a sense of how a company is doing at a glance. So the information is nowhere near complete, and you shouldn't decide on whether to buy or sell based on that data alone, but it is a good starting point. We'll go over what everything means when looking at a Google stock table. At the top, we have the name of the company, the stock exchange that it's traded on, and its ticker symbol. A stock exchange is a marketplace where you buy and sell securities like stocks, mutual funds, bonds, commodities, and so on. In this case, is the NASDAQ. The ticker symbol, or just stock symbol, is a quick way to describe a company to make transactions faster. With millions of transactions happening every day, it's easier to use a 1 to 4 letter word that represents a company than to use its full name. So each ticker is unique and you could use it to search for a stock or a fund that it represents. Right below that, you get the price of a stock or the price of a share, followed by how much the price changed from the previous day, both in dollar amount and percentage of change. If the price of a stock increased from the last day the market was open, it'll show in green with an arrow pointing up. If it decreased, it'll show in red with an arrow pointing down. The market is considered open from 9:30 a.m. to 4 p.m. Now, some trades do happen after hours, but they're less frequent and the prices don't fluctuate that much. So during those hours, you'll see the after hour price and by how much it changed. So when the market is open, the price that you see won't be fixed like it is right now. It constantly changes depending on how many people are buying and selling. So underneath, you get the stock chart. It's a representation of how the price of a share has been fluctuating over time. You have different choices of what time period to look at. So just today, year to date, all the way to max, which is from the day the company went public through today. Price of a stock alone on any given day isn't enough information. You need to analyze a company's growth and stability over time to make a good investment decision. For example, so if you look at Amazon closing price today, it only tells you that buying a share is a bit expensive right now and that it closed on Friday $14.23 higher than it is right now. But going back 5 years show you that Amazon stock has been doing very well. So if you invested in 2014 and never sold, your stocks went up in value by about 445%, which is crazy. On the other hand, if you look at a stock like GE Electric, it looks like it also closed higher on Friday. But if you go back 5 years, it doesn't look like the company has been going on an upward trajectory long term. If you bought in 2014, the value of your share went down by about 57%. So if you sold today, you would lose money. Now, below the stock graph, you get more information that tells you a little bit more about the stock. So after a normal trading day, open, high, and low tells you what the price of the stock opened at, the highest and the lowest it got that day. Now, the market cap is the total value of a company's outstanding shares. Outstanding shares are all the shares of a company available on the market. So to calculate it, you multiply the total number of outstanding shares by the price of a share. So if you wanted to know how many shares of Apple were out there, you'd divide its market cap, which is 1.17 trillion, by the current price, which is $262.2. In this case, that's around 4.5 million shares. Now, for the most part, the market cap is indicative of how big the company is. Now, the PE ratio stands for price to earning ratio. So this is a popular metric that investors use to measure the value of the shares of a company. So it could tell you if the shares are overvalued or undervalued. So you could also use it to compare the shares of different companies. So it's kind of like going to a grocery store and comparing the prices of different meats. So just looking at the price of fish versus chicken doesn't tell you which one has the better value. But if you were to look at their ratios of price per pound, then that gives you a better sense of which one gives you more bang for your buck. The PE ratio is calculated by dividing the price of a share by the earnings or the company's profit per share. Now, a high PE ratio could mean that the stock price is high compared to the earnings of a company and it's overvalued. Now, a low PE ratio could mean the opposite. Now, that's not always the case, so you would have to look at different factors to make a more accurate judgment. According to the website The Balance, a PE ratio of 40 is really high, and a PE ratio of 7 is really low, and a ratio of 14 represents the average over modern history. So based on that, you would assume that anything above 40 is overvalued or too expensive. But if you take Amazon, for example, which had a rapid growth over the past few years, its PE ratio has consistently been higher for the past 4 years. But if you look at the stock price, it more than tripled during that time. So not investing in Amazon just because of a high PE ratio back then would have cost you a lot of money. Now let's take a look at dividend yield. The dividend yield is the ratio of a company's annual dividend compared to the price of a share, and is expressed as a percentage. A company that's profitable, stable, and confident about future profits can decide to give part of that profit back to investors. Now, the money that they give back is called dividends. Now, a dividend yield tells you how much money that you're getting in dividend as an investor for each shares you own. Dividends are one of the ways that you can make money in the stock market. So when you're buying a stock, that may be something that you want to consider. But a high yield is not always good. It could be a sign of a company not doing well. So if you look at the formula for the yield, you can see that the price of a stock is in the denominator. When the price of a stock is going down, the yield is going to go up. In a situation like that, you might think it's a good stock to buy because of the high yield, but the company might be cutting its dividends altogether. So like everything else, when analyzing stocks, you need to consider other factors. Then you got the previous close, which is the price of the stock closed at the day before the market was last open. The 52-week high and 52-week low tell you how high or how low the price of the stock got in the last 52 weeks or the trailing year. This gives you a better idea of whether you're buying closer to the bottom or closer to the top. Ideally, you want to buy low. Now, I don't invest in individual companies, but I can see the same type of information from mutual funds and ETFs. So mutual funds don't trade like stocks on an exchange, so they only trade once a day after the market have closed. When you search for them, their ticker will look a little bit different and typically start with MUTF and or the letter X at the end to show that it's a mutual fund. The price you see is not the price of a stock like for individual companies, because funds can be composed of multiple different stocks, bonds, and other securities. That price is called a net asset value or NAV and represents the price of one share of all the different securities in the fund. In the section below the graph, you get the year-to-date return, which shows you the growth of the value of the fund from the beginning of the year until now. And then the net assets, which is the total amount of money that is invested in that fund. So it's the total amount of money that is under management. The front load is the fee that you pay for certain mutual funds when you invest. So using CWDIX, for example, if you're trying to invest $5,000, they take 5.75% of that and invest the rest. The yield TTM, or trailing 12 months, is the percentage of the amount of money the fund returns to investors over the past 12 months. That includes dividends from stocks, interest from bonds, etc. Now, the expense ratio is the fee that you pay every year for administrative and operating expenses for that fund. Indexed funds typically have much lower expense ratios. Some can go as low as 0.04%, like VT Sachs, and some can even be zero, like FZROX. Now, if you search for ETFs, you'll see a lot of the same things that you see for stocks because they trade like stocks during regular market hours. Now, the type of information that you get there will also depend on what type of ETF it is and what kind of securities are in that fund. Now, the information that you get from a stock table on Google is pretty simple. So if you wanted to look at something more robust, you could go to Yahoo Finance. So they have way more options and the information that you get there is more complete. So there you have it. That's most of what you need to know to understand a simple stock table. I hope this video was helpful. So please follow me or subscribe wherever you prefer watching videos. And don't forget to like, comment, share, or tag a friend. Thank you guys so much for watching, and I'll see you next week. Peace!